Welcome everyone. Today we're going to dive into the world of investing with the help of one of the most successful fund managers of all time, Peter Lynch. In his book One Up on Wall Street, Lynch shares his investment philosophy and strategies that have helped him achieve remarkable success in the stock market. But who is Peter Lynch? Well, he's not your typical Wall Street tycoon. In fact, he started his career as a humble intern and worked his way up to become one of the most respected and successful investors in the world. His approach to investing is grounded in common sense and personal experience, making it accessible to anyone willing to put in the effort. Peter Lynch is a legendary investor who achieved tremendous success during his tenure as the manager of the Fidelity Magellan Fund from 1977 to 1990. During that time, he grew the fund from $20 million to $14 billion, making it the largest mutual fund in the world at the time. Lynch's approach to investing was based on thorough research, a long-term perspective, and a willingness to invest in companies that he understood and believed in. He famously coined the term "invest in what you know" and encouraged individual investors to use their personal knowledge and experiences to identify potential investment opportunities. This approach helped him achieve an average annual return of 29% during his time at Fidelity Magellan, far outpacing the broader market. Investing can seem daunting, but it doesn't have to be. By understanding the basics, you can make informed decisions that will set you up for success in the long run. The first step is research. Before investing in any company or stock, it's important to do your homework. Look at their financial statements, read news articles, and talk to experts in the field. This will help you make informed decisions and avoid costly mistakes. Another key aspect of investing is diversification. This means spreading your investments across different industries, asset classes, and geographies. By doing so, you reduce your overall risk and increase your chances of success. Finally, risk management is crucial. No investment is without risk, but by understanding your own tolerance for risk and setting realistic expectations, you can minimize potential losses and maximize potential gains. Peter Lynch believed that one of the best ways to identify potential investment opportunities was by using your own personal knowledge and experience. By paying attention to the world around you, you can often spot trends and changes that may not be immediately obvious to others. Lynch himself used this approach to great success during his time as a fund manager. One example he often cited was his investment in Hanes, a company that made underwear. He noticed that more and more women were starting to wear pantyhose, which meant they were less likely to buy traditional stockings. This led him to believe that there would be an increased demand for underwear, and he invested in Hanes accordingly. The stock went on to perform very well, earning significant returns for Lynch's fund. Of course, not every investment opportunity will be as clear-cut as the Hanes example. However, by thinking creatively about your own experiences and the world around you, you may be able to identify opportunities that others have overlooked. For example, if you work in healthcare, you may have insights into emerging medical technologies or treatments that could be profitable investments. Or if you're an avid traveler, you may be able to spot trends in the tourism industry that could lead to investment opportunities. Patience is a virtue, especially when it comes to investing. Peter Lynch, the legendary fund manager, knew this better than anyone. He once famously said, "The stock market is a device for transferring money from the impatient to the patient." Lynch's success as a fund manager was largely due to his ability to wait for the right opportunity. He would often hold on to stocks for years, even if they were temporarily out of favor with the market. This patience paid off in the long run, as many of these stocks eventually rebounded and delivered significant returns. In conclusion, we have learned that Peter Lynch's investment philosophy is based on using personal knowledge and experience to identify potential opportunities. He emphasizes the importance of research, diversification, and risk management, and encourages investors to think long-term and be patient for the right opportunity. By applying these principles, Lynch was able to achieve significant returns as a fund manager, and his book One Up on Wall Street serves as a valuable resource for anyone looking to improve their investment strategy. Remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term approach. Don't let short-term market fluctuations or impulsive decisions derail your investment strategy. Instead, take the time to do your research, diversify your portfolio, and look for opportunities that align with your personal knowledge and experience. With dedication and perseverance, you too can achieve success in the stock market. Like and subscribe, and we will catch you on the next one.